We have some interesting news coming from Pepsi stock over the last week. It was just announced they're going to be acquiring the brand Poppi for about $1.95 billion. So this is interesting news we need to analyze, but along with this, Pepsi's a stock I've been paying close attention to over the last few months because look at this. In the last year, they're down about 15.66%, putting them right at their 52-week low. And if we look at the historic dividend yield for this company, what we can see is they're currently trading with their highest starting dividend yield in over a decade. So obviously, we need to analyze this new acquisition, look at the future outlook for this company, and look at the valuation. So there's plenty to dig into, so let's go ahead and jump in. Now, right off the get-go, if we analyze this deal, we can see they acquired this Poppi brand for $1.95 billion, but if you include the $300 million of anticipated cash tax benefits, it comes out to a net purchase price of about $1.65 billion. So let's put this into perspective of what Pepsi's generating in free cash flow and looking at their cash position on the balance sheet. So if we jump over to the dividend breakdown sheet, I've already plugged in Pepsi, and again, like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now again, to put this into perspective, we can see in 2024, it looks like Pepsi generated about $7.2 billion in free cash flow. So based off 2024 free cash flow, this acquisition would be around 24% of the total free cash flow in 2024. Now, if we go ahead and jump over to the balance sheet breakdown, again, I plugged in Pepsi. Let's take a closer look at what we have going on here. Now, we can see at the end of 2024, the cash and cash equivalents was sitting at about $8.5 billion and total current assets about $25.826 billion. So based purely off numbers, what we can see is, yes, that's a meaningful acquisition at $1.65 billion, but it's not a massive one. Basically, it eats up about 23% of 2024 free cash flow or around 19% of 2024 cash and cash equivalents. Now, if you've been paying close attention to Pepsi and the statements that the management team has been making, this acquisition really shouldn't surprise you too much. When their company released their latest quarter's earnings, the stock dropped pretty significantly on the day. It dropped by about 5%. Keep in mind, this was well over a month ago now. And the management team stated that a lot of their snack categories really underperformed in 2024. And if we scroll down, we can see one of the statements made by management is they basically said that there's higher levels of awareness when it comes to health and wellness, specifically with consumers in North America. Then he ended by stating, we're addressing through the strategies that I talked about earlier. And it turns out those strategies they were talking about was acquiring Poppi. Now, if you're not familiar with this company, this is generally considered a healthier soda brand. So this was certainly a very strategic acquisition. More than ever, consumers are looking for convenient and great tasting options that fit their lifestyles and respond to their growing interest in health and wellness. And for that reason, they believe that Poppi will be a great complement to their portfolio. So this was an acquisition that made perfect sense based off the recent earnings report and based off what management team has been telling us. Now, whether or not this was actually a good acquisition completely depends on how much revenue and profits that company is generating and how fast they're growing that revenue and earnings. And I had to do quite a bit of digging to find out this information, but one of the things I found is in 2023, Poppi's annual sales reportedly crossed 100 million, jumping 122% over year. So obviously, if they were just doing 100 million in sales, then Pepsi would have way overpaid, but when you consider the fact they're seeing triple-digit growth, it becomes a little more interesting. So it'll certainly be more interesting when Pepsi's next earnings report comes around and we can dig into those financials just a little bit more. Now, let's go and take a closer look at the dividend breakdown for this company. Like I've already talked about, the starting dividend yield is the highest it's been in a decade at about 3.73%. The company has a history of growing dividends at a decent rate for a mature company at about 7 to 6% over the past 10 and 5 years. Now, here's the concern. Look at the free cash flow payout ratio over time. The amount the company is having to use in free cash flow to actually pay out dividends is growing every single year. In 2014, we were sitting at just about 48 to 50%. Well, at the end of 2024, it was 100.56%. So the company actually paid out more in dividends in 2024 than it generated in free cash flow. This is not what I like to see, not a good sign, and it's certainly not sustainable. So we can see why the company is looking for options to continue to grow revenue, continue to grow free cash flow with acquisitions. And part of the concern is the outlook really isn't super great for this company moving forward. In fact, if we scroll down, here's what management told us. The company expects a low single-digit increase in organic revenue for 2025. When it comes to earnings, they're expecting a mid-single-digit increase. But along with this, the company also announced they're going to be increasing their dividend by about 5%. Now, this is obviously a decent dividend increase, and it's certainly on track with what we've seen from the company over the past decade, but A company increasing its dividend if its free cash flow isn't sufficiently covering the dividend starts to become a little concerning. Now, the company's balance sheet is healthy enough for this to be okay for a little while, but it is certainly not sustainable over the long term. In fact, if we take a closer look at those free cash flow trends, let's jump over to my free cash flow spreadsheet, and what we can see is the 3-year free cash flow CAGR sitting at just around 1%, and if we look at it on a per share basis, it's a little bit higher at about 1.16%, and that's because the company does buy back some of their outstanding shares. If we jump over to my screener and plug in Pepsi, come down here to shares outstanding, and again, we can see they are buying back shares, but it's not a drastic amount. If we jump over to our profitability and income statement sheet, we can see, yes, revenue's actually been growing at a somewhat decent rate, but it has started to slow down in the last few years. But if we look at two of the bright sides for the company, the gross profit ratios actually remained relatively steady over the past decade, and it's pretty good for a company in their sector. And along with this, return on invested capital, especially over the last few years, has been pretty decent at around 12 to 13 or 14%. So I do think it's clear with this recent acquisition, Pepsi is making note of the problems with the company. So I do think it's clear when you look at the statements from management team over the past few earnings report, and when you look at this recent acquisition they just made, the company understands the problems they're going through, and they're certainly looking for ways to fix it. With that being said, the question still remains, is the company an attractive option at $145.45 per share? To answer that question, let's go ahead and jump over to my stock valuation spreadsheet and come up here and plug in Pepsi. Again, thanks to ticker data, the data will load in, but let's go ahead and start off with our discounted cash flow analysis. Now, the DCF model, it's going to look a little concerning for Pepsi. If we assume 5% free cash flow growth for this company over the next decade, year over year, we're still going to come to an intrinsic value of only around $85 per share. Now, to be fair, this might be a company that trades at a slight premium due to the predictability and the stability of their cash flows. That's something investors are typically willing to pay a premium for, but that's still a pretty big difference between the current share price and the intrinsic value we found with the free cash flow model. Now, if we jump over to our historical multiples valuation, this is where things get a little more interesting. What we're doing is seeing how the market has valued Pepsi over the past decade. And what we can see is the average PE ratio over the last decade sitting at about 26, but for the trailing 12 months, it's down to about 20.85. So the stock looks about 19.44% cheaper than it has over the past decade. But again, this could be justified if the earnings growth potential of the company is now lower than it was over the past decade. But let's keep moving forward and look at our multiples valuation, the multiples comparables valuation. We have Coca-Cola and Monster Beverage Company. We can look at their price to earnings multiple, take the average, and apply it to Pepsi. And if we did that, we'd actually come to an intrinsic value of about $230.43 per share, significantly higher than the current share price. Finally, if we jump over to our dividend discount model, we value the stock based on how much it's paying out in dividends and how much that dividend will grow in the future. And assuming a dividend growth rate of 4.75%, you can see we'd come to a dividend discount model price per share of close to $175. So if we jump over to the output tab, let's go ahead and zoom out just a little bit. We can see three of the valuations we used averaged together comes to an intrinsic value of $163.24. So with a current price of about $145, looks like it's close to 11% undervalued, but with a 10% margin of safety, your acceptable buy price is about $146.92, meaning Pepsi is barely within that acceptable buy range. But if you apply a 20% margin of safety, the acceptable buy price becomes about $130.60. Now, let me be perfectly clear. This is not a high growth company, and if you're a dividend growth investor or any type of growth investor, this probably isn't the best pick for you. The people who should be interested in Pepsi are the investors who enjoy predictable and stable cash flows, who want lower volatility and also the potential for Pepsi to return to its mean valuation, basically meaning you can get some upside because you're buying it at an undervalued price. As for me, I'd personally like to buy stocks that have more earnings and free cash flow growth potential. So this was certainly an interesting acquisition that PepsiCo just made, and I'll be watching closely when the next earnings report comes out to see if we can get more information about this. But with that being said, go ahead and let me know what you think of this acquisition and of Pepsi in the comments down below. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.